In our next journal entry on March 17th, Squeeze is paying the dividends which were previously declared on the 3rd. The treasury shares which were sold on the 15th were sold after the date of declaration, so dividends will not be paid to those shares. So what are we going to do here on March 17th? Well, we've already set up a pretty good chunk of what we have to do. We've determined how much dividend is being paid to each of our two different stock classifications, 2 entries before. We were paying $9,000 to common shareholders and $18,750 to preferred shareholders for a total of $27,750. Well, now we just need to record a standard entry to pay off any liability. And any entry to pay off a liability, you debit the liability accounts for the amount that you're actually paying, and we're actually paying our dividends here, so we're going to decrease our dividends payable to common shareholders liability by that $9,000 worth of dividends that we declared previously. We are going to also decrease our dividends payable this time to our preferred shareholders by the amount that we declared in the prior entry, which was $18,750. And what are we actually giving our shareholders in this instance? We are paying these dividends in the form of cash. So here, we're going to have to go through, figure out how much cash we are paying. It's equal to the sum of those two numbers, which is $27,750, the same amount that we declared earlier when we paid our previously declared cash dividends. In the next entry on March 31st, Squeeze Toy Company is going to record the entry to close their cash dividends account to their retained earnings account. Again, dividends have to be paid out of retained earnings. They reduce the value of retained earnings, which means this entry to close cash dividends is always going to be the same. It's going to be a debit to your retained earnings account, decreasing the value of that equity account by the amount that you paid or declared for dividends during the period. And it's going to be a credit to your cash dividends withdrawal account, taking it off the books. And this entry has to be for the amount that reduces cash dividends down to 0. So if we go back and look at our prior entries, we see that we only use the cash dividends account in one entry, and that was on March 3rd, where we debited it for $27,750. That account therefore has a balance of $27,750 at this time. To reduce it to 0, we just need to credit it for the same amount. So to close our cash dividends account, we are going to credit cash dividends for $27,750 and debit retained earnings for that same amount. And when we do, we close our cash dividends to retained earnings. For the next portion of this problem, we are being asked to prepare the stockholders' equity section of our 10Q. And the 10Q is a report that corporations have to issue to their shareholders every 3 months. The Q is for quarterly. And when you prepare these and when you release these, you have to have all of your financial statements at the end of that period that you are accounting for, in this case a quarter. We have the shares that we have issued for preferred stock and common stock. We have all the associated PIK accounts we have to disclose. We have to say what is in treasury still. We also have to say what we have in retained earnings. So what are we going to do in this particular example? Well, the first thing we need to do, let's start with our preferred stock. You would denote not only the amount of preferred stock you have on the books, but what its par is, how many shares have been authorized, how many shares have been issued, and how many of those shares are currently outstanding. And that information is being provided for us. So all we need to do is figure out the balance of our preferred stock account. Well, what is the balance of our preferred stock account? Well, we just go back through, make a T account out of our journal entries, but for the sake of time and because this exercise is so short, we can probably shortcut that. We can see here that we only have one entry that mentions preferred stock at all. In the January 3rd entry, we credited preferred stock for $1.5 million. So when we go and throw that into our entry over here, we're just going to do that for the same amount, $1.5 million. You should always list your associated paid and capital accounts directly below the account they are tied to. So PIK preferred is going to be listed right underneath preferred stock. Let's go back through our journal entries and see how many journal entries affected PIK preferred. I'm not seeing any so far. Oh, there we got one in that same exact entry. We credited, PIK preferred for 1.5 million. That's the only entry that affected that account, so the balance of our PIK preferred account would also be 1.5 million at this time. That's not our only classification of stock. We also have common stock. So for common stock, we need to list the same information: what its par value is, how many shares our board of directors authorized, how many of those authorized shares were actually issued, and how many of those issued shares are still outstanding or in the hands of our shareholders. We have that information provided to us in the template, so all we need is the balance of that account. So let's go through and figure out what the balance of our common stock account is. We're going to go through and look for every entry that common stock was affected in. In this case, we had a $20,000 credit to common stock. In the February 1st entry, we had another $50,000 credit to common stock, bringing its total balance at this point up to $70,000. And at this point, I don't see anything else that affected our common stock account. So its balance must be $70,000 at this time. Underneath that, we have PIK common. And PIK common is going to be equal to the balance of that particular account's T account. So we're going to go through and look for all of our PIK common entries. We have one here. In January 2nd, we credited PIK common for $280,000. Scrolling down through here, on February 1st, we credited PIK common for $950,000, and $950,000 plus $280,000 brings the balance of that account up to $1,230,000. And scrolling down through, we have no other entries to PIK common throughout the quarter that we are listed for. So the balance of our PIK common account is therefore $1,230,000. And then lastly, for our paid in capital, we need our PIK treasury. So let's go through and see what entries affected our PIK treasury account. And starting from the top, we don't have any PIK treasury on the 1st of January, the 2nd of January, the 3rd of January, February 1st, I don't see any. On March 1st, we have treasury stock common, but that's not the same thing as PIK treasury. So no, March 3rd, there's no PIK treasury in that example. Oh, here we go. On March 15th, we have a credit to PIK treasury for $10,000. So the balance after that transaction of that account would be 10 grand. And our March 17th and 31st entry don't have PIK treasury involved at all. So we know the balance of our PIK treasury T account at this point is $10,000. And if we go and we sum up all of our different components of paid in capital, our common stock plus our PIK common, or sorry, our preferred stock plus our PIK preferred plus our common stock plus our PIK common plus PIK treasury, we come up with a total of $4,310,000. That is the amount of capital that Squeeze has raised through any kind of transaction involving preferred stock, common stock, or the profit that we got off the sale of treasury stock. That is one portion of our stockholders' equity. The other portion is our retained earnings, which we would find on a statement of retained earnings. But in this problem, it tells us that in addition, Squeeze Toy Co. has $150,000 of retained earnings on its books when they're preparing this balance sheet for their 10Q. And this number already takes into consideration the decrease the retained earnings we had when we closed our cash dividends account. So we just have to fill in that number. We have $150,000 in retained earnings. Well, those are all equity accounts. They all increase the value of stockholders' equity. But we have one account that decreases the value of stockholders' equity, and that is our treasury stock account. So we'll go back up to the top. We look through our information here for treasury stock, and we see that on March 1st, our first entry that involved treasury stock, we debited it for $180,000. And then on March 15th, if I scroll down just a smidge, we credited treasury stock common for $45,000. So what is the current balance of our treasury stock common T account at the time that we are preparing this balance sheet? Well, $180,000 minus $45,000 means that it has a $135,000 balance, and since the debit side was bigger than the credit side, it's a $135,000 debit balance. And that $135,000 debit balance is going to decrease our stockholders' equity by that amount. So let's make that number negative. There we go. We have $135,000 decrease to Treasury stock common, and we also have 75,000 shares in Treasury given in the information. So now to find our total stockholders' equity, what we do is we add together our two components, our paid-in capital and our retained earnings, and then subtract out the amount of Treasury stock we have on our books to arrive at $4,325,000, the total value of this business to the shareholders of Squeeze Toyco. Lastly, to finish this problem, on April 1st, Squeeze Toyco is going to split the company's outstanding shares of common stock. And outstanding is incredibly important because there are a few exceptions, but as a rule of thumb, whenever you split common stock, you do not split shares that are in Treasury. You only split the shares that are in the hands of the public. So we need to start this by figuring out how many shares we have outstanding before the split. Well, thankfully we put that information into the equity section of our balance sheet, and our common stock at this time has 62,500 shares outstanding. So we're going to go and fill in that information, 62,500. And to figure out how many shares we're going to have after the split, we multiply by the split number, the first number in the ratio. Well, what is our split number? Our split number in this case is 2. And what we're saying is to our shareholders, hey, we're going to give you guys a second share for every share you currently own. Well, if they own 62,500 shares, and we are essentially doubling the number of shares that are out in circulation, that means that after the split, we're going to have 125,000 shares of common stock in the hands of the public. That's one change we need to make to our shares with a split. The other change is to change our overall par value. What was the par value before the split? Again, we can go back up in here and we see that our common stock throughout this whole problem has had a $1 par. Well, since we're doubling the number of shares that are out there, but we can't change the overall value of our common stock that's on our books, what we're going to do here is we're going to divide that by the split number. This is a 2-for-1 split, so we're going to divide by 2. And if each share had a $1 par, but we're halving it, if you will, by this 2-for-1 split, that means the new par value of our shares is going to be 50 cents. And then we can record an entry. Well, what is changing our position here? Are we getting any money? We're not. Are we changing the overall value of our stock? And again, in this case, we're not. We are doubling the number of shares, but since each share is now worth only half as much, the total value of all the shares we have is still going to remain exactly the same. So for a stock split, you make another memo entry. And for this particular guy, what I do is on the top line, I write old, and I know how many shares were out in the hands of the public before we made the split, and we had 62,500 shares out, and I say what the par value was. So we have 62,500 shares out at $1 par. Well, what's it going to be after we make the split? Well, we're going to have 125,000 shares outstanding now, 125,000 shares out. And the par value of those is going to be half of what it was before, which is 50 cents. And we don't need any numbers because nothing's actually changing in our position. So all we need to do is finish this up by filling in a description. And I would say that we split common stock 2-for-1.